Today, a Squeezy Christmas postcode analysis. Hello again, it's Martin North from Digital Finance Analytics. Well, that is post covering finance and property news. The other day, I posted a show going through the latest from my core market models up to the end of November. And I had a number of requests to go into postcode level analysis, which is what I'm going to do today. So thank you for all of those who asked for more specific information. Just as a recap, the core market model takes our surveys, which we run continuously. It's a 0.5% sample across Australia. And each month we make an assessment of the mortgage stress and the rental stress, etc. for each postcode. Now, this granular information is then rolled up, and of course we can slice and dice it out lots of different ways and also form some views as to where prices may be moving from a scenario perspective ahead. Remember, the scenarios are effectively estimates. They're not trying to predict the future, but they're taking the price trajectory data, the buying and selling intentions, the migration data, the economic data, and all of that goes into the core market model plus our scenarios. And then we can look at the trajectory of prices ahead as well. And that creates a significant scorecard down at a postcode level. And so what I'm going to do in a moment is to go through some of the detail. Just for those who didn't see the earlier show, let me just remind you that we do this on a rolling basis. And so there's always 52,000 households in the sample. Oh, and incidentally, if you want a more detailed one-to-one conversation about a particular suburb or postcode, I do have a service to do that. It's not financial advice, but we can look at the underlying trends, the home price trend data, and form a view as to where things may be going. It's a conversation normally about an hour via Zoom or phone. There is a cost involved simply because there's work to be done to put it together, and you get a 30-page report, plus or minus a few pages, depending on the particular area you're looking at. If you're interested, reach for my blog. Links are below. We're booking 3 to 5 weeks out at the moment because it's quite busy, but always happy to have a conversation. And also a recap, when we talk about stress, we're looking at it in cash flow terms. So we're looking at outgoings and income. If there are more outgoings than income, excluding one-off discretionary items, then we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, in rental stress. We also look at investors as well. And we can aggregate it for the total financial stress at a postcode level, which is a key indicator of potential price movements within a postcode. We look at it in percentage terms and also in counts. The latter, I think, is probably the best way to talk about it. The reason I talk about this is because there are small postcodes that move around quite a lot because from a sampling perspective, it's a relatively unscientific affair. But as you move into the larger postcodes with larger numbers of people, then the accuracy is much, much better. And the bottom line is that the rule of big numbers, I think, does play out. Now, just to remind you that when we looked at the stress data for November overall, we saw that the rental stress was still very high at 77.1% of those in the rental sector. That's as high as it's been pretty much forever. It's a disaster for many people. The mortgage stress is also up just over 50%. So just over half of those owner-occupied mortgage holders are having cash flow pressures. And of course, the debt-to-income ratio from the RBA remains pretty high relative to where it was, despite what everybody says. There's no doubt in my mind that lending rules are more generous than they were some time back. And of course, there's even more pressure to try and reduce the borrowing criteria even more, particularly for first-time buyers, which to my mind is pretty nutty in the current environment. And here is the top-level story for November that showed the 50.4% of those in mortgage stress, that's 1.8 million households, the 77.1% in rental stress, that's 2.3 million households, the 16.5% of investors who are stressed and looking to perhaps to get a shot of a property, that's 492,000, and overall financial stress at 47.7%, more than 4.7 million households, which is just under half of the 9.9 million households across Australia. And you can see there the state breakdown. So now let's start looking at the specifics based on the postcodes that we were asked to look at. Oh, and by the way, just for those who have not seen it before, This is, I picked out postcode 2090, which is where I used to live, by the way. This is a way of looking at it. So we have the household data, we have the stress data, we have the property mix data, the people ratio, which is how many people per house, the vacancy rates, the gross investment yields, the gross investment yield being the ratio between the price and the typical average rental. Net investment yield is the cash flow for the investment property, taking account of both income and expenditure on the investment property, including things like mortgage interest rate payments and maintenance on the property and management fees. We then have the taxable data. Now, the ATO data is for the year 21-22. The census data is based on the base census from 2021. Of course, that's updated less frequently because the census is run every 5 years. And then what we're able to do is to look at two things: the disposable monthly income calculation. So this is on average in this postcode. What is the average disposable monthly income? What proportion of it is going on the typical mortgage and the typical rent, both in percentage terms, and also we can look at the absolute value. And then finally, we can form some views as to the price trajectory based on our three scenarios: the best case, the base case, the worst case, depending on the trajectory of interest rates and economic factors more broadly. And you can see here in this example, in the best case, there is a small rise for houses over the next 3 years, cumulatively speaking. Units also true, but if we get a base case where in fact rates stay high for longer, and worst case, if we get a recession and as a result of that, we have higher unemployment, then prices still have risk to the downside. The base case is the one that I tend to focus on more, but with a slight bias towards the best rather than the worst case, given the fact that we expect governments to intervene more to try and prop up the property market if prices started to slide, especially, of course, coming into an election. So with that introduction, let me now go to the first audience-generated request. This is from Daniel for postcode 4163 up in Brisbane and Moreton in the Cleveland area. And here, there are just over 7,000 households with 40% earning outright, 29% borrowing, 30% are renting. The stress levels are relatively low, you can see there, although there is more stress in the rental sector. We see this quite consistently in many postcodes at the moment. 60% of the places here are houses, units 19%, other types of property. That could include, for example, living over shops or indeed other types of accommodation. The people ratio 2.11 suggests that it's not just individuals who are living in individual properties, it's families as well and couples. The vacancy rate at 6.7% is, middle of the road. Gross investment yields 4.4%. That's quite consistent. Gross investment yields up in Queensland don't look too bad generally, but the net investment yield here is negative. They're losing money. You can see that the average taxable is 87,000. The census data was 74,000, and that gives a disposable monthly income of just over $5,000. 47% are going on the typical mortgage at $2,400 and 39% going on the typical rent at $1,999. And looking at the scenarios ahead, the best case is a significant rise, maybe 14% over 3 years for houses. The base case, a small fall, down 5% over 3 years, cumulatively speaking. The worst case, a more consistent fall. And units following along. Now, Antonio asks for postcode 2111, which is in the area around Gladesville and North Ryde. And here we have 6,600 households. We have 29% earning outright, 33% borrowing, and 36% renting. We can see there that 14% are in mortgage stress, 71% are in rental stress. There is some investor stress there too. Overall financial stress is 68%, so that's quite high. 45% of houses, 41% of units, and other types of property at 13%. People ratio is 2.2. The vacancy rate at 8%. Gross investment yields at 3.6% positive. Net investment yield, again, is negative. And I must highlight, we're seeing more and more examples now where net investment yield is negative. One reason why more property investors are quitting. The taxable income from the ATO was 118,000. The household census was 120,000, giving a disposable monthly around $6,800. Average mortgage is around $3,600 a month, which is 52% of disposable monthly income. And the average rent is about 1/3 of disposable monthly income, around $2,200. Looking at the scenarios, the best case scenario is a very small rise over 3 years. The base case is a significant fall. The worst case is a dramatic fall. And I'm afraid to say that units are following on there too. Now, John asked for postcode 2070. So this is in the Linfield area of Sydney. So 5,400 households here, 40% owning outright, 34% of borrowing, 24% of renting. The stress level is 16.7%. The rental stress at 87% is very high, and overall financial stress is also quite high. There are some stressed investors here too. You can see 60% of houses, 36% of units, and a small number of other types of property. People ratio is 2.59, so that'll be including families as well as just individuals or couples. The vacancy rate was 8.7%. Now that's based on the original census, of course, and that was taken at the end of COVID, so it might be a little off. The gross investment yield is 3.5% positive. Net investment yield, again, negative, minus 1.1%. And I want to underscore again, these net investment yields are getting significant. Now, looking at the taxable income, you can see there that the ATO said 144,000. The census data said 154,000. Now, you'll see a little flag here. This is a new innovation I've just brought in, where we are seeing consistently higher household level income relative to individuals. That suggests that multiple incomes are going to pay the mortgage. And so we're seeing that in this particular postcode. On average, the disposable monthly income is around $8,500 each month. The amount going on the mortgage is around 49%, which is $4,200 a month. And the typical rent at 36.9% is $3,140 a month, both quite high numbers. If we then look at the scenarios, well, even the best case scenario, there isn't much growth, small fall over the next 3 years. The base case, a significant drop of 20%, and worst case, 41% over 3 years, and units following on. Simon asked for postcode 6172, and this is in Port Kennedy, Western Australia, in the district of Brand. 4,800 households here, 21% owning outright, 55% are borrowing, that's very high, of course, 22.8% are renting. And you can see here that the mortgage stress data is showing significantly high numbers here. Now, it says 100%, that's plus or minus a couple of percent off, but the fact is we have a lot of pressure here, and overall financial stress is at 81%. It's pretty much all houses, 93%. The people ratio is 2.6%. The vacancy rate, 6.1%. The gross investment yield is 4.1%. But again, the net investment yield is minus 0.8%. So once again, people are underwater from an investment perspective in cash flow terms. Looking at the taxable income, the ATO said $72,000 per annum. The census said $99,000 per annum. So the multi-flag is up. Multiple incomes are going to pay the mortgage. The typical disposable monthly income is around $6,200. The typical mortgage is about 32% at just over $2,000 and 28% at $1,745 for the rent. And I will make the point that we are seeing in many areas of WA, mortgages actually are lower because prices, although they're recovering from where they were, did take a significant hit in previous years. So Western Australia tends to be a little bit cheaper relative to other parts of the country, although, again, disposable monthly income ratios are continuing to rise, looking at both the mortgage and the rental payment. On the scenario basis, best case scenario for houses is up 4% over 3 years. The base case is a small fall, down 16% over 3 years. The worst case is significantly worse, 36% down, and units are following on. Now, Simon also asked for another postcode, 6225. This is Collie in Western Australia in the district of Kalgoorlie. Here, 3,800 households with 42% owning outright, 38% borrowing and 19% are renting. A lot of mortgage stress once again. Financial stress relatively high as well, 38%. Mostly houses, 93%, small number of units and types of property. People ratio is a little lower, just over 2. Vacancy rate was at 12%. And the gross investment yield is 3.5% positive, but again, the net investment yield is minus 0.9%. The average taxable is around $68,000 for the individual and $64,000 from the census, giving a disposable monthly around $4,300 a month, with 35.6% going on the typical mortgage at $1,560 a month, and 28.4% or $1,245 going on the typical rent. And from a scenario perspective, best case is a significant rise in prices of 17% over 3 years. The base case is a small fall, particularly in the out years there, down 2.5% cumulative, and the worst case down 22% cumulative over 3 years. And I should say, if you want more information about the scenarios, check out my earlier show. The links are below, where I go through those scenarios in some detail. Finn asked for postcode 4655, which is Craignish in the Wide Bay area up in Queensland. Here we have 28,000 households with 45% earning outright, 28% borrowing, 26% renting. 9.3% are in mortgage stress, 81.8% are in rental stress, stressed investors at 19.2% and overall financial stress at 29%. 84% are houses, 2.7% are units of the types of property, 13%. We have a people ratio of 2.13%. We have a vacancy rate of 9.1%. The gross investment yield is 4.4%. Net investment yield is positive, whoopee, but only 0.1%. Average taxable, $58,000 from the ATO and $57,000 from the census, giving a disposable monthly around $3,969 a month on average. 43.5% going on the typical mortgage at $1,727 a month, and 42.7%, $1,694 going on the typical rent. From a scenario perspective, best case is a rise of 15% over 3 years, the base case a fall of 4.4% over 3 years cumulative, and the worst case down 24% over 3 years, and units are following on. I also had a request in the West, in Pingelly, in Curtin, 3,800 households with 6.1% earning outright, 65% are borrowing, and 28.5% are renting. Mortgage stress at 97%, very, very high. Rental stress at 33%. Stressed investors at 10% and overall financial stress at 76%. And you can see there that 97% are houses, small number of units are types of property. So this is a high growth corridor area over in the West. Quite a lot of those around, of course. The people ratio is 2.53%, so tends to be households rather than just individuals. The vacancy rate was 6.8%. Gross investment yield was 4.1%. The net investment yield is flat, absolutely no return, but no loss either, 0%. According to the census, the household census said household income was $105,000. The individual data was $74,000. So it's a multiple contribution to the mortgage payments. People are leveraged up. And looking at that, the disposable monthly income is around $6,100, with 37.8% of the monthly income going on the mortgage payment at $2,340, and 29% at $1,794 going on the typical rent. Looking at the price scenarios, best case, a rise of 12% over 3 years cumulatively. The base case, though, a fall of about 7% over 3 years, and the worst case, a fall of 27% over 3 years. And here's another request that I had for postcode 7262. This is down in northern Tasmania at Bridport. Now, I would say this is a very low count, so we need to be cautious about this, just 827 households. But nevertheless, we know that 46% earning outright, 32% of borrowing, and 21% of renting. And you can see there that the mortgage stress and rental stress figures are very high and giving a very high level of financial stress. The housing data shows that 94% of houses, 3% of units are types of property. We have a low people ratio, so a lot of individuals here rather than families. We have a vacancy rate of 39%, so this could well be coastal, it could well be holiday accommodation, Airbnb, etc., etc. That's a very high ratio there. Gross investment yield is 4.8%. Net investment yield is positive, 1.4%. In fact, that's the best we've seen today. Average taxable from the ATO, $119,000. From the census, $63,000. Looking at the disposable monthly income, on average, $4,800 a month, with 32% going on the typical mortgage, $1,560 a month, and 25.5% at $1,205 going on the typical rent. Looking at the scenarios, even the best case scenario is suggesting further falls in Tasmania. maybe 8% over 3 years cumulatively. The base case, a more significant fall, and if things fell off a lorry, then it would be dramatically lower units following on. And the last one I'm going to do today is postcode 2330. There are 8,200 households there in the postcode, with 31% owning outright, 41.8% of borrowing, and 26.7% of renting. And you can see here that mortgage stress is 85%. That's very high. Rental stress, 92%. Some stressed investors, giving financial stress at 66.8% overall, which is very high. Looking at the property mix, 87% of houses, some units and other types of property there. The people ratio is higher at 2.41, so that's going to be some families as well as individuals. The vacancy rate was 8.5%. The gross investment yield was 3.3%. Net investment yield minus 0.8%. The average taxable from the ATO was $77,800, but $101,500 from the household census, indicating multiple incomes going to pay the mortgage. Typical monthly disposable income in the postcode is just over $6,800, with 32.1% or $2,184 going on the typical mortgage, and 24.5% or $1,670 going on the typical rent. From a price scenario perspective, the best case is a small rise cumulative over 3 years of 1.8%, the base case a fall of 18%, and the worst case a fall of 38.6%. So that gives you the latest information from our surveys. And I would just say that if you are interested in a particular postcode, if you contact me by the DFA blog, I'm happy to send you the one-page summary. On the other hand, if you want to get access to the entire data set, more than 2,000 postcodes we calculate each month, you can do that via our Patreon program. There are actually a different set of tiers available. Some of those just support me, but if you go to the $50 a month tier, you can actually get the latest data, which has precisely the same information as I've gone through for each of the postcodes. And if you're interested in thinking about property trends, and specifically spotting where the opportunities may be, that data set is very, very powerful. So if you go to my Patreon program or go to the DFA blog, I'll see the links in the comments below. You can sign up for that. And just before I go, let me also make this point. It is very important that people who are in some financial pressure take steps. We are not going to see an instant correction because rates are not going to be cut anytime soon, in my view, and the government has limited capacity to throw further support out, although there's an election coming, they'll do something, I'm sure. It is very important, though, if you are in some financial stress and financial difficulty, to seek help, but be careful where you get that help from. I recommend the National Debt Helpline, which is 1-800-007-007. This is a government-backed and funded support program, and they are extremely busy, but also very helpful. I've had a number of people who have been very significantly helped by having a conversation with the helpline. So 1-800-007-007. The other point I'd make is that some people just need to sit down sometimes to think about where their income is and where their expenditure is. And this structure, using the AFCA's Statement of Financial Position, which is available as a download from their site, is extremely powerful. It gives you a very, very good basis to understand where you actually are. Not only does this form potentially, which takes 10 to 15 minutes to complete, give you some good information for yourself, but if you then need to reach out to the bank or reach out to a debt counselor, it's a really good basis. So I do recommend that, and it's been a very helpful tool that I've seen a number of people use. I'd also make the point, of course, that at the end of the day, households need to take some responsibility for their financial position. And once you know where you are from a cash flow perspective, money in, money out, then, of course, you can prioritize appropriately. Look at those debts, for example, with very high levels of interest rate. See whether you can get those paid off first. Be careful, though, of reaching for more loans, and also be careful of just refinancing with the bank. The bank will often extend and pretend, but sometimes that doesn't necessarily really help in the long term, as the recent asset report highlighted, that sometimes at the end of that hardship program, people are actually in a worse off position than before. One of the things that we're seeing in our surveys is that households now are considering taking more radical steps, for example, listing their properties, And I would expect to see property listings rise again after the Christmas and New Year break, because now we are very much at the pointy end of this. Interest rates will stay high for longer, probably into next year, as I made a show earlier on talking about that. And so it really comes down to individual households taking responsibility and trying to figure out what to do. Anyway, hope you found that useful. Thank you for those who asked for the specific information on postcodes. I hope that was helpful to you. And as I say, if you want specific information from a postcode, drop me a note via the DFA blog and I'll send it out to you. And as I said earlier on, if you want to get the Patreon program up and running, you can get the data sent out. I'll be sending this data out to all of my Patreon followers in the right tier over the next few days. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.